Well, if you're getting close to buying a home, the last thing you want to do is get denied for a mortgage, right? And that's happening maybe more and more. At least we're seeing it a little bit right now. So we wanted to kind of talk about that a little bit today in this video. Talk about what you can do to make sure you're not putting yourself in that position to where you'd be denied and throw off the whole home buying experience for you and your family. Welcome in. This is the Smart Mortgage Show. I'm Ben George. He is Bill Litton, Regional President of Cross Country Mortgage. Bill, good to see you. I know we're going to talk a little bit here about this denial, trying to avoid that. What can you do to put yourself in the best position? Because, I think this does happen, and we see it on listings where, the buyer fell through, financing fell through, so a home is back on the market. It's not uncommon.
It happens more than you would think, and I think it's totally avoidable. So we've built a system and a structure to try and avoid that, because that can be really painful and emotional. You get your hopes up, you think you're buying a house, you start outlaying cash for deposits and inspections, and you get denied at the end. That's a pretty painful life event. So definitely avoidable, and some good things that we can look out for.
Yeah, no, the reality is that, the lenders will re-verify everything right before closing, right? So they'll go back through your entire financial life. So even something that might seem trivial or small to you might actually throw off everything. So we want to make sure that you're aware of these deal killers today and things that might set you up for denial, so that you can make sure you're in the best position possible. So let's start here with the interest rate trap. Bill, explain this one to us.
So basically, one of the things that we've seen happen is you get pre-approved and you're pushed right to the limit. Okay. And now interest rates go up, and whatever lender you're working with doesn't re-verify that everything works from a debt ratio perspective, because the higher interest rate has now pushed up the debt ratio, and now you don't qualify. So, that can be an issue. Also, debt ratio related would be, you're buying a house, you're excited, and you go out and you buy a bunch of new furniture and you put it on credit to do so. Now you don't qualify, because adding that new credit card payment or installment loan payment in your debt ratio pushes you over the limit. So you want to be really careful with your debt ratio, as far as if you're going to take out any new credit, wait till after settlement, or even if you need to do something, if it's an absolute emergency, talk to your lender about it, because there might be a way to solve your problem, but with them knowing exactly what you're trying to do, they can lead you through it with minimal to no pain a lot of times.
Yeah, that's important. That debt to income ratio, you don't want that to get to a certain level. So again, that's probably one of the most common reasons why this happens, but that's one we want to be aware of. Second thing here, Bill, is what would be, I guess, mystery money, or these deposits of money that you get that aren't verified, right? Because as a lender, you're legally required to track where that money's coming from, right?
Yeah. So I want to say that once you're under contract to buy a house, the most time-consuming, detailed part of the process is verifying your funds to close. We track all kinds of paper trailing, deposits. Certain deposits are not eligible, or they're not allowed to be used as part of the transaction. So one of the things we see people use sometimes is cash, where they'll deposit cash. Cash is absolutely not allowed. Now, if you have cash, and we've talked about it, there may be a way to use the cash, but we do that through some strategic planning. So cash is an issue. If, let's say, you sold a boat and you got $10,000, well, in that case, you might be able to use it because you sold an asset, but there's a very specific paper trail. So again, get your lender involved, bring all of this stuff to the surface up front, so you can work on, together, solving all of those issues. The other thing too is gifts. You might get a gift from somebody, and that gift might be from an ineligible source, or it was going to be a gift from mom, but then it actually came from dad. That's going to create problems.
Yeah, the biggest thing is you want to make sure that's not a loan, right? Like that's the whole thing
That's
is you don't want
that's
just
it.
money coming into your account and with the idea that you're giving it back, the lender's got to make sure that that's not the case.
Absolutely.
All right, third point here is moving jobs, right? So we talked about this before. You kind of have that 2 year history of consistent income here. That stability is so important for you guys. So even if you get a fantastic new job offer, Bill, should you wait on taking it?
This one comes up a lot as well. And, there are scenarios where you could take a new job, leave your old job, start a new job, be in the transition of going from old job to new job, and it be fine. There are also scenarios that would absolutely derail your financing and you'd be turned down, you'd be denied. So you definitely want to have those conversations with your lender, your loan officer up front to make sure that you're navigating. We always say, and in every email we send, we always put in some caveats and some things to look out for, cautionary items. One is don't change jobs during the middle of the process, or if you're going to consider it, let us know because, hey, you might be able to get the better job and get the house too. But if you don't talk it through with your loan officer, it could cause, damage that we can't, irreversible damage. It also might be fine, but you wouldn't know that unless you talked it through with your loan officer, which is really important.
And Bill, if this isn't something you should worry about, like if I'm doing one job, let's say I'm a marketing director at a company, and my next job is a marketing director, same position, just a different company, that's not going to reset the clock and make me ineligible, correct?
So chances are, if it's the same type of a role and the compensation structure is the same, you should be fine. You don't need to be at the new job for 2 years. Sometimes we can use what's called future income. Future income means I verify your income and your debt ratio based on a job you don't even have yet. So there are a lot of flexible allowances to try and work with folks that are bettering their career and getting into a better position. But there are scenarios where maybe you were a marketing manager and your base salary was 100,000, but now in the new role, your base is 50 and it's heavily commissioned and you have no commission history, no historical performance that we can look at and say, okay, he does really well or she does really well in commission jobs. That's going to be an issue.
All right, good to know. Next point here, to make sure you're putting yourself in the best position not to get denied, is that appraisal gap here, Bill. And I don't know if this happens quite as much as it did, just a few years ago when the market was so competitive that oftentimes you had to make an offer above asking price, right, in order to get in there. But there can be some problems, right? The appraisal doesn't match up.
And there's still a lot of multiple offer scenarios where people are waiving the appraisal contingency, which means no matter where it appraises, they don't care. They'll make up the difference one way or another. So really important is working with a lender and a realtor that are explaining how all of this works, making sure that you know exactly what you are responsible for if you waive an appraisal. And it's more common than we'd like it to be, but if we're up against cash and there's no appraisal required, and we have a really strong buyer and they're in a great financial situation, so we're not putting them in a bad spot overall, but they need to know what they've signed up for. So if the house doesn't appraise and they don't have the cash, in that scenario, you could be denied, especially if you're at the max financing limit and there's nowhere to go. So now you don't have enough cash to bridge that gap. Your deposit could be at risk.
Yeah, that's one that's not uncommon either. Last one we want to kind of bring to your attention is credit score and having drops in your credit score. And I think people think, well, Bill, I'm not going to open up any new credit cards. I don't have to worry about that. But there's other ways that your credit score could drop that you might not be aware of.
Yeah, this one, we're very careful to make sure that we're pulling updated credit reports and soft credit checks enough to, if something happens, we know about it before our buyer goes under contract. or a borrower goes under contract. But this can happen. Let's just say it's not about opening a credit card, but maybe you had 5 credit cards, you stopped using 2 of them, and now you closed 2 of them thinking you're doing some good maintenance, right? Some good credit maintenance. Well, now you've just cut yourself off from credit. And the way that the algorithm is going to read that with the credit bureaus initially is going to be our utilization ratios are higher. We've cut ourselves off from credit, and your score could drop in the short term.
All right. So these are, again, 5 things, just some pain points to be aware of. For anyone that's kind of starting this process, Bill, maybe a little nervous, hey, I don't want to get denied. What are some easy things they can be doing? Is it just mainly about communication during the process with your lender?
Yeah, I would say it's, look at who you're working with, look at their reviews, make sure that they've got lots and lots of 5-star reviews. Make sure that if you can, get a referral for a reputable lender. If you're working with a real estate agent, they probably have a reputable lender that they refer. I would say the other thing to do is make sure that they're reviewing your income and your credit, and maybe even get a fully underwritten pre-approval. So now it's not the loan officer saying you're pre-approved, you're actually underwritten approved. And not only is that going to be safer for you, but it's also going to be stronger when you make offers, because the other side, the seller of the house and the listing agent, are going to be able to look at that underwritten approval and say, this is stronger than a pre-approval. It puts your offer in a higher category, more likely to win in a multiple offer scenario.
All right, very good. Well, reach out if you have questions for Bill. Just text the word LEND to 21,000. Again, it's an easy way to set up that conversation with Bill and begin talking about, what your goals are, what you're trying to accomplish, and really what the best mortgage option is for you. Bill and the team at Cross Country Mortgage have been doing this for a long time, and really will help make you aware of some options maybe that you aren't aware of going into this process. And we talk about a lot of those here on the show. So go back to some past videos. If you have questions, maybe want to learn more, get more informed and educated about the lending process and what might be available to you, just check out our show. We appreciate the support as always. Subscribe if you haven't already. We appreciate you, and look forward to talking to you again here on the Smart Mortgage Show. This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.